Well, the 19 things you need to know about filing your 2025 taxes. Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. Well, the Big Beautiful Bill Act changed a significant number of rules and benefits for 2025. Our IRS expert Dan Pilla is here today to tell us what we need to know. Hey, Dan, welcome to Prudent Money.
Well, it's good to be here, Bob. How you doing?
I'm doing good. You know, I was thinking about everything lining up, everything's going pretty good with tax season, and then the taxpayers realized that the one big beautiful bomb just went off, and now everybody's confused. Does that about sum it up?
Well, there was a lot of changes in the code. That's true. I don't think I'd call it a bomb, though, Bob. I think the fact of the matter is for most middle class Americans, the bottom probably 80% of income earners are going to have a tax. They're going to see a reduction in their tax liabilities. In fact, the IRS has already reported that tax refunds are up in 2026 for tax year 2025, and they're up anywhere between a couple of hundred to $1,000. The average tax refund last year was right around the $3,000 mark, and this year it's more like $3,300, up to as much as $3,900 to $4,000. And the reason for that is because of the breaks in the tax code that were created by the One Big Beautiful Bill Act. And so, again, I mean, there's obviously it's never good, Bob, when they stir the pot as often as they do. And I think that's reprehensible when they keep doing that. But the fact of the matter is that this particular bill helps middle to low income Americans. No doubt
right.
about that.
Yeah, well, this 19 critical points article that you wrote, I think, is just dead on and something that everybody needs to be looking at. You can get more information on this at taxhelponline.com. Well, let's talk a little bit about this, about what you need to know. The very first one out of the gates, you talk about the due date of the return. Talk to us a little bit about what we need to know about the due date.
Well, yeah. I mean, April 15th is the due date. It falls on a Wednesday this year, so there is no extension as a result of a holiday or a Saturday or Sunday. That always has the effect of pushing the deadline out to some other place, and that's not the case this year. Nor do we have any administrative extension of the filing deadline, which happens from time to time when the IRS does this or that. And so it's April 15th. It's as simple as that. Now, the other thing people need to know is that you can get a filing extension. And so the filing extension is available if you file Form 4868 with the IRS on or before April 15th, and that gets you 6 additional months file the tax return without any failure to file penalties.
But there's some downside to that. I mean, people think that they're maybe not having to pay their taxes, but the penalties and interest will start compiling.
Yeah, that's exactly right, Bob. The extension of time to file the return does not give you an extension of time to pay the tax. All right, the tax is still due on April 15th. Even if you get an extension of time to pay, even if you get an extension of time to file. And so people need to know that there is a payment extension that's available, and that is IRS Form 1127. Form 1127 is an application for extension of time to pay the taxes, and that is not automatic. The filing extension is, but the payment extension is not. And so that you need to have a reason, Bob. You need to have a good reason why you cannot pay on time, why payment might cause a hardship, how it is that you did the things a reasonable person would do to provide for their tax liability, but you couldn't pay on time. That has to be explained in the application, and then the IRS can deny it, of course, because it's discretionary, and so you got to have a good reason.
Yeah, one of the things that you talk a lot about, and I think is especially in today's time, is keeping everything as proof, receipts, anything like that that show when you did what was whatever process you went through with filing the tax return and making sure you're very, very organized. Probably more critical than ever.
It is. It is. And the reason for that, and this is not new, this has always been the case, but people don't realize this, Bob, and that's the burden of proof is always on the taxpayer when
Yes.
it comes to these kinds of issues. If the IRS says you didn't file your return on time, you have to prove that you did. If the IRS says that you're not entitled to this deduction or that deduction, you have to prove that you are. They don't have to prove you made a mistake. You have to prove that you did it right.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. IRS expert Dan Pilla is talking a little bit about what you need to know for the tax season this year, for your 2025 taxes. One of the things that you talk about in your list is file on time, even if you don't have the money. It's
Yeah,
almost doesn't even seem to make sense, but talk a little bit about that.
Well, it's a critical thing, Bob. A lot of people make the mistake of not filing the tax return because they don't have the money to pay, and they'll say, well, how can I file the return if I can't pay the tax? Well, not having the money to pay the tax is not a physical impediment to filing the return. So what happens in a situation like this, Bob, if you don't file the return, then the IRS piles on with the penalties. The penalty for failure to pay the tax is up to 25% of the tax liability. And the penalty for failure to file the return is up to 25% of the tax liability. So what happens is you run the risk of doubling the penalties on the tax liability if you don't file the return, even though you can't pay the money. So don't fail to file the tax return just because you don't have the money to pay the tax. What'll happen when you file the return and you don't full pay the taxes, the IRS will begin the notice process. And then you can begin the discussion process of setting up, a payment plan with the IRS or setting up some sort of situation where you can resolve the liability. But they're going to add that penalty for failure to file, and just because you don't have the money to pay the tax is not a defense to fail to file for the failure to file penalty. So don't run the risk of doubling the penalties.
One other interesting thing that you talk about that doesn't seems like it's in the wrong order, but I know it's not, is a key point you make is how to handle past IRS debt with the IRS versus current filings. And you say get current, then address the past due debt. It almost doesn't seem it's almost kind of counterintuitive.
It is counterintuitive, and this is one of the reasons why people get themselves on what I call the tax debt treadmill. And the tax debt treadmill, Bob, is where you use current tax revenue to pay the back tax liability because people think they got to get the old stuff resolved before they can start addressing the new stuff, and that's exactly the wrong approach. So, for example, here we are in 2026, right? We're in April, or what are we? March of 2026, middle of March 2026. You are now 1 quarter in to 2026's tax compliance season. Right, so if you're self-employed, you must have made your upcoming up here in the next few weeks. You'll make your first quarterly estimated payment. If you're a wage earner, you've got all of those taxes coming out of your paycheck now for 2026. So the responsibility is to pay the current taxes in full and on time. If you owe the IRS $1 million, they will play ball with you, Bob, if you're current with estimated payments for the current tax year. If you owe the IRS $100, they won't play ball with you on the delinquent stuff if you're not current. So in other words, even $100 tax liability is not going to be negotiated by the IRS if you're not current with 2026 liabilities. So what happens, the mistake people make is they'll use their current tax revenue. In other words, they'll reduce their withholding on their paycheck, or if they're self-employed, they'll fail to make sufficient estimated payments so that they can fund some kind of excessive installment agreement for the delinquent liabilities. And that's the wrong thing to do. Pilla's first rule of tax debt management is this: if you've got money to pay the current taxes or money to pay the back taxes, but not both, never pay the back taxes. Always pay the current taxes because the IRS will negotiate on the back tax liability if you can't pay it. They will not negotiate with you if you're not current.
And I'll admit I've never really heard of this. But this was in your list. The FBAR deadline. Talk a little bit about what that is and why taxpayers need to know.
Well, yeah, taxpayers need to know this, Bob. Not every single taxpayer falls into this category, but a growing number of U.S. citizens do. The FBAR filing date is the foreign bank account reporting requirement that provides that if you have control, if you're a signature over or an owner of any foreign financial account, and the value of that account is more than $10,000 at any point during the calendar year, so we're talking about 2025 now, then you've got an obligation to file this FBAR report with the United States Department of Treasury. That FBAR report is due on April the 15th. It is not a tax form, Bob, and this is what throws people. People think that, well, I just submit this with my IRS form. No, you don't. You got to go to the Treasury Department's website, their FBAR reporting website, and it's a specific form that gets submitted electronically through that website that reports any foreign bank account balances. Now, to make things even more complicated, the IRS has a separate form that must be filed separately if you have assets, and I think the cap is 50, or the floor is 50,000 on the IRS form, but it's only $10,000 on the so-called FinCEN form, the Financial Crimes Enforcement Network FinCEN form. It's FinCEN form 114, whereas the and that's $10,000, whereas the IRS form is form 8938. And I believe the threshold there is $50,000, but that's a different form altogether. So you got these two separate reporting requirements, Bob, with two separate thresholds under which they kick in. And don't ask me to explain why the federal government has created two separate forms with two separate threshold requirements that get filed in two different places for the same exact reporting information. Of course, it's irrational and it's insane, but they got to do what they want to make it as complicated as they can.
So you mean you're not going to let me ask you the tough questions of why the world is the way it is?
Well, it depends on what that's all about, Bob. If you're asking me why the Internal Revenue Code is the way it is, you're going to have to change the subject.
I'm very clear. I've known you too long to know that to be the truth. So let's talk a little bit about reporting digital asset transactions. Talk a little bit about that. I mean, I would assume that's really becoming more and more of a big deal every year.
It is becoming more of a big deal every year. The IRS has really been cracking down on digital asset transactions here over the last 5 years, to the point where they've added a question on the top part of the tax return, Bob. So right underneath the name and address part. I mean, you don't even get into listing your income yet, and you got to answer the question whether you received, sold, exchanged, gifted, or otherwise dispose of a digital asset during the course of 2025, you got to check the yes box on that tax return, and so you got to be truthful about the information. And so purchasing, right? Notice that the word purchase is not in the list, but if you received, sold, exchanged, gifted, or otherwise disposed of a digital asset, then you have to check the yes box. And the reason for that is real simple. The digital assets, Bob, are treated just like any other asset under the Internal Revenue Code. So if you sell a share of stock in the ABC Corporation, you got to report a gain or loss on the sale of that stock. And digital assets are no different. The IRS takes the position that a digital asset is just like any other piece of property, like a stock or a share of a mutual fund or a bond or any other security you can think of, and that's how it's taxed. So if you buy that you buy that cryptocurrency for $1 and you sell it for $2, you got a capital gain of $1 that has to be reported.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Dan Pilla is with me here today talking about tax time and filing your 2025 taxes. About cyber currency, can you give us a tip or two as far as how some of the best practices, some of the things that you need to consider at tax time this year?
Well, the first thing you need to know, Bob, is your buy and sell stuff has to be tracked, all right? and most of these digital clearinghouses now, these I forget what the fancy name they have is for them, but the digital clearinghouses will give
Mm.
you a full report of your trades, right? That is helpful when you've got that information, that record keeping information. But here's the other thing that people that people fail to recognize. It's easy enough to understand gain or loss when you sell a crypto asset, right? I bought it for $1, I sold it for $2, I've got a $1 gain. Or I bought it for $2 and I sold it for $1, now I've got a $1 loss. That's easy enough to do. But people make the mistake of thinking that if you trade your asset, your digital
Mm.
coin,
Mm.
you've got ABC coin that you trade for XYZ coin. People think that's not a taxable transaction, and that's not true. When you trade that coin, you have essentially sold that asset, Bob, at the fair market value on the day of the trade, and of course the asset that you get back in return for the trade has a basis in it equal to what you equal to what you realized on the sale of the first coin. Right? This gets a little technical, but the fact of the matter is, just because you trade the coin does not mean that a taxable transaction did not occur. And I think this is problematical with people that are using their digital assets in a digital wallet, and they're buying things in the marketplace using their digital coins as U.S. currency. Because let's say you go into the hamburger shop, Bob, and the hamburger shop it takes your digital wallet to pay for the transaction, and you buy lunch for $15, and you use 1/100th of a coin to pay for that lunch. You sold 1/100th of a coin for $15 to buy that hamburger, to buy that lunch. And that transaction constitutes a sale. And you have to calculate your gain or loss on that sale and report it on your tax return.
You know what was scary about that is the vast majority of people don't know that information. I would imagine.
Well, I would have, and I know that you're right about that. And the other thing is, the vast majority of people aren't keeping track of it, Bob.
Right. Well, let's talk a little bit about the standard deductions. How have they changed for this coming year?
Well, they've gone up a bit. The standard deduction for a single person is $15,000, and for married filing jointly, it's $30,000. And the standard deduction kicks in, Bob, automatically, which means that if you don't want to take the time or effort to itemize your deductions, or the value of your itemized deductions is less than the standard deduction, then you're just better off claiming the standard deduction. Now, itemized deductions include mortgage interest, charitable contributions, state and local taxes, and certain medical expenses, right? So if you add all of those items up and they exceed the value of your standard deduction, then you're better off claiming the itemized deduction. But if they don't, and in most cases they do not, about 70% of the people, Bob, that file tax returns do not itemize their deductions. They claim the standard deduction simply because they just don't have an amount of standard itemized deductions that gets them over that hump. And so the numbers go up every single year, and so this is an easy way to take advantage of a deduction without having to have any proof of it.
I can't remember how far back we go on this, but it seemed like that they changed the system a little bit to where it almost just canceled out if someone was giving a lot of money, contributing to a ministry, that they didn't really even get that deduction for it.
Well, you can get the deduction, Bob. That's an itemized deduction. But the question is how much. For example, suppose you're a married couple filing a joint tax return. Suppose you have $60,000 worth of income on your return, all right, and of income. And suppose you tithe 10% of your income. Well, you're giving $6,000 to church or charity, right?
Mm-hmm, right.
$6,000 is way under $30,000.
Right.
And if the $6,000 is your only itemized deduction, it would not benefit you to claim the $6,000 on the return. You're better off claiming the $30,000. So that's where it comes into whether you actually claim the specific deduction or not. Now, there's one thing that's important, and that's on my list here, and that is the One Big Beautiful Bill Act added an additional deduction for charitable contributions of up to $1,000, and you don't have to itemize to get them. All right, so let's take that example I just gave you. You got a married couple that gives $6,000 in charitable contributions, and they don't itemize, so they're going to claim the $30,000 standard deduction. But in addition to that, they can claim the $1,000, or actually $2,000 for married filing jointly, for charitable contributions, even though they don't itemize on the tax return. So they will get some additional benefit for charitable contributions under these law changes.
Now, there was one item on your list, and I wasn't aware of this. This was the employer credit for paid family and medical leave. Talk a little bit about that.
Yeah, this is a relatively complex credit, and the IRS has got a notice out that gives the details, and so you can go to the IRS's website, and in the search box you just put in employer credit for paid family and medical leave. But the way it works, Bob, is if the employer is providing this benefit to his employees, right? Paid family medical leave, paid family and medical leave. They're giving that benefit to their employees. Then there's a credit that's available to the employer for doing that. In other words, a credit is better than a deduction, Bob, because a deduction is marginal, right? If you're in the, let's say you're in a 20% tax bracket and you've got a deduction for $1,000, that saves you $200 in taxes. But the credit's dollar for dollar. So if you get a $2,000 credit on your tax return, that reduces your tax liability by $2,000. It's like somebody else paying your taxes for you. So if you're an employer and you're providing these benefits to your workers, then go to the IRS's website, as I said, and put those keywords into their search box there, employer credit for paid family and medical leave, and you'll get the details on how that works, and make sure you talk to your tax preparer about it so you get the benefit of it.
Last one here, Dan. We'll talk a little bit about the child tax credit. How does that work?
Well, the child tax credit was put into law to replace the deduction for dependents. Right? We no longer claim deductions for dependents on the tax return. Now you get a credit for every qualifying child under the age of 17 who's a U.S. citizen, and that's $2,200. It's $2,200 per qualifying child, Bob. So if you got 3 or 4 kids, and again, this is a credit, right? And so this is a big deal here. And part of the credit is refundable, meaning that you can get more back from the government than you paid in the first place.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. Actually, I've got one other question that I want to ask, and we got about a minute. Probably not fair to ask this question. Would like your opinion on converting IRA money to Roth accounts, and does that make sense to do so at retirement?
Well, it depends on what your age is, Bob, because when you convert that regular IRA to a Roth IRA, you've got a taxable distribution equal to the amount of your IRA, and then the money's got to sit in the Roth for at least 5 years.
Right.
Now, once it's in the Roth and it sits there for 5 years, you can draw it out tax-free. If you're young enough, that makes a lot of sense. But if you're about to start your retirement distributions, it might not make sense to do that. I think it's that's something that you got to sit down with a guy like you to figure that out as to whether that's a good move for an individual or not.
Yeah, I've always had a very strong opinion about that. And when you talked about we're on the same page, just curious as to what you thought about it, because that's getting marketed pretty hard to people, and I just don't think that is just a slam dunk. Absolutely, that's what you do 100% of the time. Really does. You got to get some benefit for all that money you just paid in taxes.
Yeah, exactly right. That's exactly right. And the question is, how long is it going to take you to recover the tax?
Yes.
That's the first question. And if you're still working and you've got maybe a 15 or 20-year timeline, then maybe it's going to be easy enough to recover that, and especially the gains from the investment over that period of time, which are of course not taxable as long as they're in the IRA. And then you take the money out and it's not taxable. Well, that can be great benefit. But if you're 75 years of age, it might not make sense to do that.
Right, right. Well, Dan, great to have you on the program. Once again, taxhelponline.com is where you go to get more information about Dan. Great talking to you. We'll talk to you next month.
My pleasure, Bob.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.